Happy Friday, everyone, and welcome back to Open Exchange TV, sponsored by the great team at Open Exchange. As usual, we've got the Friday Musings here with Jay Pelosky, who's all smiles after Duke's win last week. How are you, Jay?
Feeling good, Scott. Thank you. And thanks for that shout out last week. That was great. Really enjoyed that.
It was our pleasure, our pleasure. Now, you've got your musings this week, and once again, you're getting me back in the territory which I know nothing about. You're talking about the Grateful Dead. You've titled it A Line in the Sand. What do you mean by a line in the sand?
Well, it really came out of our portfolio review, which we do every month. You know, we have two model portfolios at TPW Advisory, our global multi-asset and our TPW 20 thematic model. So we update every month. We went through that process this month. And there was just such a line between what you read in terms of the sentiment and the headlines and the negativity and what the portfolio review reflected, which was namely, and I know we'll talk about it down the road a little bit here, but namely that, you know, the things that were leaders over the last period for us were a combination of commodities and emerging market assets. And if things are really going to heck in a handbasket, you know, those are not the things that lead. So the dichotomy between what we're reading in the press and what we're hearing from sell side people and what the portfolio was showing, you know, actual performance is not congruent. And it just kind of the line in the sand kind of just struck me the other day. And so I did know it, you know, as someone who is a Grateful Dead fan. I mean, you've made your allegiance to the Bee Gees known, and that's fine. Or maybe it was ABBA. But, you know, as a Grateful Dead fan, we know the Fire in the Mountain classic Grateful Dead tune where they talk about the line, a point beyond which you really won't go. And so lines in the sand, to me, reflects a lot of what we've seen in the markets over the last couple of weeks.
I'm actually more of a cold chisel guy, but you're going to have to do a bit of research on them.
Yeah, cold. Okay. I don't even know what that means. No one knows what that means. Okay, so you follow some obscure, you know, Outback band. Good for you.
One of the greatest bands in Australia ever. Anyway, lines in the sand. Like, listen, we've all drawn them in our lives and so forth, but where in particular are you drawing a line in the sand?
Well, I mean, I think it's reflected in many spots, right? So one is in the interest rate space, right? Let's remember Europe is now out of ZIRP. Remember ZIRP, zero interest rate policy, and the fear about negative rates? Okay, so that line in the sand is crossed. Europe now has positive interest rates, and I think that's good. And markets suggest that's good as well. Euros rallied, European stocks have rallied. What about lines in the commodity space? Remember all the fear about Russia shutting in the Nord Stream 1 gas pipeline? Well, lo and behold, they did it over the last week. And what have prices done? Dutch natural gas benchmark prices down 40% from the high of 2 weeks ago, down 40%. Or how about lines in the policy front, right? The EU is capping energy prices and going to support consumers. China is drawing a line under its property market woes, cutting interest rates, providing a bailout fund. So there are a number of these different lines. And then to add just one more, there's obviously lines in wartime. And over the last couple of days, it's become clear that the Ukrainian advance is making significant headway, and they're threatening to cut off much of Russia's forces that are in Ukraine, kind of cutting off their line of logistics. So there are many different lines. And then, of course, there are the lines in the markets as well. The S&P bouncing off its 61.8% Fibonacci retracement level this week, inflation break-even lines. You know, you think about the 5-year forward break-even, now at 2.5%. It was at 3.6 back in March. It's right in line or close to in line with the 10-year average of roughly 2%. So there are a lot of lines, and we think the action in looking at these different lines in the sand are actually suggesting that maybe we're moving past a lot of this uncertainty And much of that uncertainty, much of the risk is actually in the price. I mean, that's really the takeaway, that a lot of the fears that people have, and there's plenty to be fearful about, is in the price. And I think the European reaction to Russia's shutting the Nord Stream 1 pipeline is as good an example as one can think of. You shut that's the big fear. You know, that's been the fear for months. They're going to shut the pipeline. What do? Well, guess what? They shut the pipeline and natural gas prices fall 40%. The euro stabilizes. European equities are up from when that happened. That's not what people expected to see when the event actually, transpires.
Okay, well, obviously we like the line in the sand theory. I do like that. But the ECB, let's move on to ECB talking this week. And obviously a lot of market move on the back of it. Like, what does their message mean to you?
Well, we wrote last week with our monthly about the real message from Jackson Hole, right? Was not that more pain was coming, but that the low growth, low inflation environment, the post-GFC regime is over. And we're moving into something different, which we call the high nominal growth world, right? Arguing that we're going to have a slightly higher inflation, and the Fed is going to validate that. Well, similarly, in the ECB case, all the news, of course, is the 75 basis point hike, the biggest they've ever done in the history of the ECB. Our message that we took away was their changing of their forecasts, particularly on the growth front. So while every newspaper and pretty much every sell side analyst, strategist, economist you want to read is talking about either a Europe in recession or about to go in recession, the ECB growth forecast for 2022 is 3%. Their growth forecast for next year is 1%. They don't see a recession. So again, kind of one of these lines in the sand, right? You have pretty much the entire sell side universe talking about Europe in recession, and the ECB talking about 3% growth, not like 0.5%, 3% growth this year. And growth in the first half, by the way, was quite strong and just got upgraded. I mean, I believe it was 0.8% quarter over quarter growth in Q2. So pretty robust, stronger than the US. And we saw that in the earnings for Q2 as well in Europe. And it's worth pointing out that even today, looking forward, there are more upgrades than downgrades in European company advice to the sell side. So to us, the real message is Europe is the big fear with Russian gas is gone. The EU is working collectively to deal with the issues, protecting their energy market, protecting their consumers. You see the difference between UK going it alone post-Brexit and the EU collectively dealing with the issue on a collective, regional, integrated basis, which resonates with us with our tripolar worldview, of course. That's exactly what we talk about, and that's our vision of the world. And the EU is actually manifesting it through COVID and now through the energy crisis. And those are really the key takeaways from Europe for us, not that the ECB raised 75. Great, they're going to raise rates more. We actually think they're going to raise rates more next year than the Fed, which is one of the reasons why we're bullish on the euro versus the dollar.
Okay, well, let's move this back to the US then. What do you expect from the Fed? And what do you think it means for inflation?
Yeah, I mean, I think we're coming up on a very big turn. And it's interesting, right? Because you and I were talking just before we went live about how a number of sell side folks have come out talking about big declines in the coming weeks and the next month or so. I counted 3 or 4 people talking about 20% declines either in September alone or in October. And so there's a lot of fear out there. To us, what we expect to see is we got a good jobs number last week, right? Participation rate up, average hourly earnings down, better than expected. Next week, we get CPI. We think the CPI number is going to be below July's. It's going to, again, reflect the view we have, which is inflation is rolling over. We think it's going to set the stage for the Fed to raise rates 75 basis points the following week. But again, importantly, the important point is not the 75 basis point hike. The important point is it's going to be the last of the front-loading 75 basis point hikes, which we think is going to signal a turn in the dollar. And to us, the dollar is really key. And again, just as every headline is about King Dollar and dollar wrecking ball, we think the dollar is just about to roll over. Its technicals look stretched. Its fundamentals look unattractive if you look at the exploding current account in the US. You have folks like JP Morgan talking about their dollar momentum indicator being in extreme bullish territory, which means it's only got one way to go, which is to be less bullish. You have interest rate differential shrinking, right? As ECB raises rate 75, all of a sudden that big gap between US rates and European rates shrinks because the ECB is raising rates at a similar clip to the Fed. So on a number of fronts, we think you can see the rolling over of the dollar, and that we believe sets up for significant asset allocation opportunities across assets, whether it be equities, commodities, et cetera.
Well, talking about asset allocation, being that we've just gone through the end of the month, like you've obviously had some time now to do your monthly review. What were your key takeaways from that review?
Well, it was really interesting, Scott, because again, we touched on it at the open, right? Negativity all around us. B of A talks about appallingly poor sentiment in its latest FMS survey report. And yet, lo and behold, when we did the work and looked at which, what was the performance of the models and what led to the performance, what was really interesting and what really struck us was that amongst the leaders, so in our global multi-asset model, we have about 28 different ETFs, right? We have stocks, bonds, commodities. And of those 28, the top 5 best performers were a combination of commodities, primarily energy, which was interesting because oil was down over the last month, significantly down, right? But energy was the leader. And then emerging markets were the other 2. Then when we extended it out to the top 10 best performers, 8 of the top 10 were commodity or emerging market names. One that stood out, for example, was KHYB, which is our Asian high yield bond fund, right? All we hear about is the implosion of the China property market. But yet, lo and behold, one of our top 5 performers was an Asian high yield bond fund. So the negativity and the actual performance, these are facts. This is not an opinion. This is a fact. This is what this instrument did over the last period, roughly the last month. That's really telling to us. And then the fact that 8 of the 10 were EM or commodity, URNM was in there, right? Our uranium play, which we've talked about, that's been really strong, reflecting the focus on climate. Asia has been strong, our Southeast Asian equity ETF. Brazil has been strong. You look at Brazil as just an illustration, right? I mean, it's trading at about 6 times forward earnings. Currency is very cheap relative to the dollar. And their interest rate profile, their inflation rate peaked close to 14% back in April. It's now about 9%. Yet their 3-month money, the CWIC rate, as it's known, is approaching 14%. So Brazil has some of the highest real rates in the world. And it suggests that as the Fed moves from front loading 75 down to 50 to 25, much of EM we think is going to be done with their rate hiking exercise because they began last year well ahead of the Fed. And so to us, when we look at the performance, the leaders, we decided this month that we wanted to kind of lean into strength, right? We wanted to continue to allocate to those areas that are leading, figuring that if we're right, that's where new money will come in to the leaders. And if we're wrong, that relative strength should support us. And so basically what we've done is we've added to our energy positions, both in the clean energy and in the fossil fuel energy space for our global multi-asset model, as well as on the climate space in our TPW20 model. Climate, for example, now represents 40% of our TPW20. It's the single biggest segment. Last month, we added to emerging markets. That's working out well. This month, we're adding back into energy, both clean and fossil. And we think JP Morgan, for example, on the energy front, did a deep dive this past week on energy and noted how attractive it was across multiple factors, not just valuation, not just momentum, but across a range of factors. Energy is screening for them as by far the most attractive sector. And so we feel comfortable adding there. And in our view, where the world is not going into recession, right, where we have a desynchronized world between US and Europe slowing, Asia, particularly China and Japan recovering, that the demand for commodities should pick up. And on the last note, I just mentioned that Dr. Copper himself this week up 5%, with storage issues and inventories being the lowest they've been in quite some time. The world is not at all set up, nor are investors, for the rollover of the dollar and for the realization that we're not going into deep recession, either in the US or in Europe. When that reality starts to kind of inhabit people's minds and they start to allocate, they're going to allocate to commodities, they're going to allocate to emerging markets, they're going to allocate to Europe, and TPW Advisory will already have been there and will be saying thank you very much.
It's interesting. Shortly, we're going to be doing a video with an FX hedging company called Diaglo. They've been very busy in Latin America. So it might be an opportune time to get you to sit down and talk with them as well.
Yeah, I do. I mean, we're quite bullish. We have a big position in EWZ in Brazil. So we're therefore bullish on the real. But yes, and you recall I was in Mexico a month or so ago talking with the Afores and made the old cab ride. We could talk about the cab ride test, right? How much does it cost to get the ride from the airport? Remember, in Mexico case a month ago, it was at an 80% discount to the trip from Manhattan out to Kennedy. The trip from the airport to Mexico City, the center of Mexico City, was an 80% discount to what it cost me to go from Midtown Manhattan to JFK.
So well, you're always riding in style, though, Jay. We know
that. Yeah, exactly. Believe me, it was nothing special. Point was that Mexican peso is very cheap. The Brazilian real, very cheap, right? That's the point. And so love to get together with these folks and talk about emerging markets and Europe. I mean, the OECD just came out this week, noted that on a purchasing power parity basis, the euro is 40% undervalued. 40% undervalued. I mean, there's just the positions are so stretched across a number of things. When we move in the other direction, and as I said, we think the key is the dollar rolling over, it's going to be huge. I think it's going to be big, and I think it's going to last for years. We're at one of those inflection points, line in the sand. That's the title. That's our view.
Well, FX hedging sounds like it's going to be a big part of it for a lot of different companies going ahead. But Jay, thank you very much for your time as always. Love talking to you on Fridays. You have a great weekend. Enjoy the football and sit back and relax for a little bit, okay?
Well, I'm hoping to. I do note that Duke is favored to lose by roughly 10 points against Northwestern. I'm hoping for a different outcome, better outcome. Blue Devil victory.
Good luck to your team. And for everyone else out there, good luck investing.